Hey guys, Whitney here. Welcome to the Passive Investing Made Simple show. Thank you guys so much for taking time out of your Tuesday to join me. I'm going to give us just a little bit for everybody to join in the Zoom room. But if this is your first time joining, thank you. This is a live show where we deep dive into all things around passive investing so you can go into your first or next investment with confidence. So be sure to hit subscribe on your podcast or YouTube player and register at Passive Investing with Whitney Made Simple. PassiveInvestingWithWhitney.com for future masterclass sessions. Check out our open deals. And if you'd like to, schedule a call with me. But today I have on a very special guest, Andrew Davis, our Director of Investor Relations and Investor Services. Andrew, welcome. Thank you so much for taking time out of your day to join us.
It's always so good to be here with you.
Yeah.
Thank you for having me.
Absolutely. All right. So Andrew, not everybody here knows you, and not everybody knows what you do here with PassiveInvesting.com, but take me through a little bit of your story of how you got into real estate and then how you got into passive investing.
Yeah, absolutely. So let's see. The very unoriginal way I got into real estate or real estate investing was a chance reading of Rich Dad, Poor Dad back 20 years ago now, or almost. And of course, like so many of us, that just unlocked the power of assets and understanding assets versus liabilities. And it kind of confirmed what I already thought, or it was very validating to me because I was not I didn't love school. I did well, but I didn't want to go and get multiple degrees and kind of run that corporate ladder. And I was really fortunate to have entrepreneurial grandparents and parents, and I just was exposed to that from an early age. And so I just always loved the idea of blazing a different trail, and I very much saw real estate investing as a way to do that. And so started out in the single family space. Putting together using like FHA loans and things like that to buy my own properties at owner occupied properties at low 3.5% down payments or 3% down payments. But then also really in my mid to late 20s, got really interested in the idea of building a rental portfolio, and then B, mostly out of necessity, raising money from other people, or OPM, as Robert Kawasaki would call it, other people's money. And so I found my first flip in Florida back when, gosh, it's almost 10 years ago now, and just had developed a little network of private investors, private money lenders, was able to raise the money for the purchase price for that deal. This was back in 2014, bought a great property in Orlando for $92,000, which would be impossible today, but at the time it was a great deal. And did a rehab, partnered with a contractor. I think we broke even, learned a ton, and repeat. And I got up to 16 units, some small multi and single family rental properties. And I was exhausted. And the idea of getting up to 100 units, which was my goal at the time, just felt like I've put in so much work and effort. Some of these properties are barely cash flowing, and we can get into the economics of that. But I knew there was a better way. I'd spent enough time reading and researching and networking to know, hey, there's this whole other world out there where you can go buy 100 unit apartments. You don't just need to have your own money. There's all these different structures and ways to do it. And that fascinated me. But I also knew that was a whole nother level. That was institutional level investing. And that was not something that I was going to endeavor to just take on my own. What became very clear to me in that process is where I was strong and what my skill set was, and also very clear to me where I was not strong and who I needed to strategically partner with or surround myself with in order to be successful in the space. And so I really just started looking, researching other syndicators, operators, real estate sponsors, and PassiveInvesting.com just came up over and over again as a great group to work with, and started lightly stalking the principals of the company. And just so happened that around the time that I was really ready to make that transition, position opened up. This is 2 years ago, almost to the date, to be an investor relations associate or consultant, I believe the role was, and just jumped in and took over for Dan Hanford, one of our managing partners, pretty quickly in handling most of the inbound investor phone calls and questions and leads, et cetera. And then we just grew. So, when I started in 2021, in 2020, they had raised about 63 million in equity. My first year, 2021, we raised about 197 million. Last year, 2022, almost 300 million, and now have a team of, 5, 6 investor relations, investor services, and it's just been a really great journey. And so, yeah, my focus at the company is really making sure that our investors have the best experience possible from start to finish, that they're getting their questions answered in a timely manner, that they have a really good understanding of who we are and what our strategy is, and then just making sure that we're continuing to communicate well with them through every single stage of the process. So that's me.
Excellent. Well, thank you so much for sharing. And I can identify with so many different parts of your story, especially about the putting the early hustle on your own controlled real estate assets, and then kind of slapping yourself in the head a few years later going, wow, they don't cash flow exactly like I wanted them to. And then you get to that point where you start calculating your return on your time. You're like, ooh, it's leveraged, right? It's a great way to add income. I'm not poo-pooing it, okay? But
no, it's a great way to, and more so than income, it's a great way to add equity. I mean, we've taken some of those early properties and traded up or moved that capital into syndication. So I think single family investing is great, especially from an equity formation perspective, or when you're very early starting out. So I think it's a key part of it. It's still a part of our strategy. It's just not the primary part of our strategy.
Well, let's talk about that, because you talked about trading up, which every time I hear that, I think of Monopoly, right? 4 single houses and you go buy yourself a hotel or a multifamily building, right? So that's kind of what we're talking about today, is like how to do that.
Great segue.
Trade up. Yeah, you like that? You like that? No, just kidding. Unplanned, guys. Unplanned. You leave Andrew alone, and Andrew and I alone in a room, and you'll just hear laughter the whole entire time. But anyways, I'm going to try to keep this serious for everybody here.
Sorry.
That's okay. But anyway, so the 1031 exchange, right? For those of you who are not familiar, maybe you haven't invested in real estate before, you're like trading up assets. How do you do this? Andrew, can you just, give us a small, little nugget around what is a 1031 exchange in real estate? And then we'll start kind of applying that into syndicated assets.
Yeah, absolutely. So in general, a 1031 exchange, or what's known as a tax deferred exchange, is basically a way to avoid or delay paying capital gains tax. And so, for example, in the scenario we just discussed, maybe you have a property that you've owned for a long time, a duplex or a single family home or an office building or something like that. And over time, you've paid down the principal on it and it's appreciated, and you're getting ready to sell that property. And maybe you have a gain of $300,000, or maybe you have a gain of $3 million. Well, depending on the amount of time you've owned that asset, if it's over a year, then you are going to be subject to what's called long-term capital gains tax, which is just a bit over 20%. So say on a $300,000 gain, you'd be paying the federal government $60,000 for the privilege of selling your own property. And if it was a $3 million gain, you'd be paying them over $600,000. And so back in the day, I couldn't tell you the exact year, but this provision or this vehicle entered into the tax code. And basically what it states, or what it allows you to do, is in lieu of paying those taxes and taking the gain, what you can do is you can do a tax deferred exchange. And you can actually take your gains from the sale of that asset, and you can transfer them or roll them into the purchase of another like kind asset. And if you do that within some general guidelines, you can actually avoid paying the 20+% capital gains, long-term capital gains on the equity or on the profit from that sale. So it's a beautiful way, A, to avoid taxes, but then B, automatically redeploy your equity from one asset into another, potentially larger, more profitable, scaled up asset. So that's the high level. There's some nuts and bolts. That's effectively what a 1031 exchange is.
Awesome. So, and I just want to stack on top of that, it's not just about the capital gains, because an investor's probably been taking depreciation this entire time, or the IRS
Right.
thinks they have, right? And so
Mhm.
you're also deferring that the recapture tax on the depreciation.
That's right.
So it's nothing to be scared of, because I know when you and I talk to investors all the time that are like terrified of this, and we're like, the
Yeah.
IRS, they can't solve the housing problem. They don't want to be in small business. They don't want to deal with real estate. So they incentivize us as the investor through this 1031 exchange.
That's exactly
Now,
right.
before we kind of unravel this whole like-kind part, why is
Mhm.
it important for an investor to consider doing a 1031 exchange as opposed to just selling the asset and paying the tax bill now and not having to worry about it again?
Well, I mean, that certainly can be an option, and some investors will elect to do that. However, if you are strategic about your 1031s and about your exits, and I think the 1031 strategy, I think a lot of people look at it as a tax deferral strategy, or like you said, a way to avoid that depreciation recapture. And it in the near term, or in the kind of the immediate sense, it very much is. But I think more than that, what the 1031 exchange is, or is part of, is a generational wealth strategy. And so if you think about, say, just to use very easy numbers, say you bought a single family home and did some improvements and owned it for 3 to 5 years, and then you sold it and you exchange it for a fourplex, and you keep doing that, and you keep increasing the size and following this strategy. If you're strategic about it, and if you're patient about it, over 15, 20, 25, 30 years, you can A, defer a tremendous amount of taxes, and B, turn something that might cash flow a couple $100 into something that's cash flowing thousands or tens of thousands of dollars per month if you're really strategic about it. So, of course, tax deferral and the depreciation recapture, we're deferring that as well. But even more so than that, it's really a generational wealth strategy,
I love
which I
it.
know
The
is music to your ears, Whitney.
I know, I love that. But
Yeah.
I mean, so to kind of put a different spin on that, it's
Yeah.
about the time value of money and the velocity of money,
Well,
right? Like,
exactly. Yes, exactly. Yeah. Yeah.
yeah.
Because you're effectively losing 20% of your investable capital every time you sell and take that capital gains hit. So yes, absolutely.
Now I'm going to drop a little nugget here because you haven't
Oh boy.
mentioned this. And
Mhm.
guys, we are not tax professionals. We're not legal professionals. If this is something that you're looking to pursue with your assets, know that if you continue to kind of kick the tax can down the road with the 1031 exchange strategy, as long as you die with the asset in your name, or still in your possession, there could be a step up in basis to your heirs. So do the taxes ever come due? As of right now, no. So this is something really to sit down with your tax strategist and your legal counsel to make sure it's the right strategy for you. But again, like you said, Andrew, such a powerful multi-generational wealth strategy.
Yep.
Now, classically, investors have been told that they can't 1031 exchange from their own controlled single family, long-term rental, any asset they had in their personal name or in their personal entities into a syndicated asset, because it isn't a like kind of exchange. You're not trading real estate for business, right? That's what you're technically doing with a syndication. But let's pull that back. But you and I know that that's not true. So how
Mhm.
can investors actually pull off a 1031 exchange into a passive syndication?
Yes. Well, one of the things that we have not covered, and maybe this is a question later, but it's a nuance that really is very important if you are 1031ing into a syndication, or what effectively is a partnership, from a place of individual ownership, is when you 1031 into a syndication, you are going to come in as what's called a tenant in common. And so from an organizational, um, like if you're looking at an organizational chart of ownership of, say, an apartment asset, for example, you're going to have multiple owners from an organizational perspective of that asset. And so when you want to 1031 exchange into a syndication, you have to come in as, from a legal perspective, a co-owner. However, one of the huge advantages of investing into a syndication is all the legal protections that you are afforded. And so generally when people are 1031ing out of active ownership into a syndication, they're doing it because they're tired of active ownership. They don't want to be involved in the day-to-day management of the asset. They don't want to be an owner. They want to be a limited partner, right? They want the benefits without the responsibility or the liability, and fair enough. Who doesn't? So when you 1031 exchange into a syndication, there's one nuance when you look at the organizational chart and kind of how that functionally works is you come in what's called a tenant in common position, but then you are invested through what's called a special purpose entity. And being invested via that special purpose entity, and if I always want a whiteboard when we talk about this because I feel like I should draw it, but it would probably be illegible. Then through that special purpose entity, basically what that does is it for all legal intents and purposes, puts you in an LP position. So you have the same protections as an LP, you have the same hands-off, no ownership responsibilities as an LP, but are still participating. You're still an owner and are still participating in the returns, the upside, the tax benefits, et cetera. One nuance with 1031 exchanging into a syndication is that your timing has to align. And so is this a question for later?
No, I mean, it's a question. Let's answer it now.
All right, very good. So sometimes I get ahead of myself. And so when you're 1031 exchanging, basically from the time that you sell your asset that you're looking to exchange, you have 45 days to identify up to 3 replacement assets. And they give you that 3 because things don't always work out and closings get delayed. And so you want to have options. So even if you're just watching this right now and you're thinking, I only want to partner with passiveinvesting.com. It's always good to have backup assets because things happen. Closings get delayed. There's deals fall apart, whatever it may be. And so basically what you want to do is you want to make sure that your timing aligns. So you want to be able to identify an asset, or up to 3 assets within 45 days or 45 days after your closing. And then you have up to, once you've identified, you have up to 180 days or 6 months to actually close or make the purchase. And that's 180 days from the sale date of the asset that you sold, not 180 days from the end of the 45 days. So there are 2 concurrent timelines starting the date of the sale of your asset.
And you
Did I say that right?
You can even add a little bit more timeline to that because if you already know that you want to do this strategy, you can get ahead of the game a little bit.
Exactly right. That's exactly right. Mm-hmm.
Especially like when you put your asset under contract, be it 30 days, 60 days, now you're tacking on to that 45-day, 180-day timeline. Now, okay, so let's just put a little pretty bow on this. Like, so what are some of the advantages for doing a TIC? And then let's, contrast that with the challenges. I know you already kind of stated that, but, we were going through in context of definitions, but, let's bullet point this for people, make it easy.
Sure. So the advantages of being in a TIC position, to summarize the question. Yeah. So the advantages of being in a TIC position is really all the protections that are afforded to you as a limited partner. And I say TIC is specifically a TIC in a syndication, because you can be in a TIC not in a syndication. The TIC is a legal is a way to hold property, but a TIC within a syndication through that special purpose entity, the beauty of it really is you are completely protected. So you're protected in terms of exposure to any liabilities around the debt or any issues that may arise at the property. So you've got those legal protections. You're still participating. You still have an owner. You have equity in that asset. So you have an ownership share in that asset. So you're participating, of course, in the cash flows from that asset. You're participating in the upside of the sale or a liquidation event, like a refinance, not a liquidation, a capitalization event. And also you're participating in the tax benefits as well. And then again, you're hands off from an ownership or from an operational perspective. So you have ownership, but from an operational perspective, you can read the monthly updates and check the financials and whatever that sponsor is providing to you in terms of the performance of the asset. But you can put your feet up on the weekends and not worry about calls about tenants and toilets.
Awesome. All right. So who is this not for? A TIC.
Who is this not for? Well, it's generally, and this is really going to be dependent on the sponsor, but generally what you'll see from a sponsor is they're going to have a minimum for a TIC or somebody coming in via a 1031 exchange. And the reason for that is lenders are going to limit the number of TICs in an asset. So you can't have 27 TICs. Usually what we see is lenders start to I think the most we've ever had in one is 5. And that's usually about the max that lenders want to see, because there's just a lot of additional documentation and paperwork that goes into the acquisition process, the ongoing reporting process, and then a lot of work from the sponsor's perspective as well. And so, for example, for our group, and we're one of the more kind of generous on our minimums, if you want to 1031 exchange into a storage deal with us, then we set the minimum at $500,000. And if you want a 1031 exchange into a multifamily deal with us, we've set the minimum at $1 million. And the reasons for that are just as stated, and also just because it's a tremendous amount of administrative and legal work and cost to our team and the partners that we work with. And so we just want to make sure that it's worth our while.
Mm-hmm. And, for some investors that are sitting here going, oh my goodness, like I have like 10 single family properties I want to exit out of, but each one does not have $500,000. You correct me if I'm wrong, but they could potentially sell that as a package and aggregate that equity together and bring that all in together, correct?
That's correct. Yep. So you can exchange, you can take multiple properties. Again, the nuance that timing the sale. So you'd want to make sure that it was they were all actually sold together, which could very easily do. And then, yes, so that's correct. You can take those proceeds and exchange those into a syndication, a larger syndication.
Awesome.
And one of the key parts of this too, or one of the key components of this is for anybody that's thinking about this, is you actually work with what's called a qualified intermediary. So there's actually people that this is all that they do. They facilitate 1031 exchanges, and so they'll basically help you with the process. They'll answer any questions that you have, kind of let you know what you need to look for in terms of a replacement property, and then when you actually sell your current asset and are looking to exchange, they actually the gains from the sale will go into an escrow account that they hold. And so you don't actually ever touch that money. They hold that for you, and then when you're ready to exchange into a new asset or to purchase a new asset, they'll release those funds at the appropriate time.
Good piece of advice there. So if an investor wants to 1031 funds, or if they think they're going to be doing a 1031 this year, what are the next steps they can take to make this process a smooth one?
Yeah, so I think preparation is key here. Really, identifying what you're looking for as an investor in terms of what are your priorities with that capital. Like if you're looking to 1031 into a syndication, are you looking for cash flow? Are you looking for upside? Kind of how conservative do you want to be in terms of market selection and asset class selection? And then really interviewing sponsors. You want to make sure that you're with somebody that's done this before, and you want to make sure that you're if you're really going to looking to partner with one or a couple specific sponsors, you want to make sure they have a track record of closing as well. And so if they have a bunch of deals that don't quite get to the finish line or whatever, that's gonna create some additional stress and anxiety for you, obviously. And then I think lastly, I just lost my third point there. Yeah, I would just say, get on the phone with sponsors and figure out what their pipeline looks like. Because if your property's not on the market yet, and generally, like for example, our group, what we see is Q1 is generally very quiet for multifamily acquisitions. So if somebody called me today and said, hey, I want to exchange into some multifamily, I would say, hey, wait, if you can, wait to put the property on the market, kind of wait to get the ball rolling until Q2 probably, because that's when we really start to see our pipeline ramp up there. So really, I would say, yeah, just be very proactive about reaching out to sponsors, identifying your requirements and what's important to you in terms of the deal you're exchanging into. And yeah, just do as much of that due diligence up front. And then, for example, with our group, every time I talk to a 1031 exchange investor, I've just got a sheet. I know what they're looking to sell, what their exchange amount's going to be, what their tentative timeline is, or what their actual timeline is if they are already sold. And then they're getting weekly or biweekly updates from me, just kind of depending on the need there as to what's in our pipeline that they could potentially identify. So it's a real partnership between the sponsor and the investor.
All sage advice. Andrew, thank you so much for
Yeah,
joining us today. Where can people get a hold of you and find, perhaps schedule some time with you?
sure. If you just send me a fax, no, you can send me you can send me a
Smoke
note.
signals, right?
Carrier pigeons. No, Andrew at passiveinvesting.com is probably the easiest way. And LinkedIn is really the only social that I use. So you can just search Andrew Davis, passiveinvesting.com there. But if you send me a note, Andrew at passiveinvesting.com, we'll get time on the calendar to connect.
Excellent. Andrew, again, thank you so much for joining us today and imparting your wisdom. And, for all of you here live, don't go anywhere. We've got several questions queued up for Andrew. We're going to put him in the hot seat. But if you are listening to us on your favorite podcast player of choice or on YouTube later, again, thank you so much for investing your time in yourself and spending it here with us today. Be sure to join us at passiveinvestingwithwhitney.com for all future masterclass sessions.